Welcome back. What's the best strategy for your portfolio as we head into the end of the year? Well, who better to ask than one of this country's top-rated financial advisors? Richard Saperstein is that person. He's with Treasury Partners. He joins us now. It's good to see you again.
Likewise.
So we're like 42 minutes in. Not a single person on the show today said they're worried about anything. The consensus was stocks are going higher between now and the end of the year. Is that a justified feeling?
Well, by all means, the equity market is overvalued. Whether it's on 25 earnings, 26 earnings, or even 27 earnings. However, we're still fully invested, and I think investors have to recognize that we're up 115% in 5 years. Maybe their asset allocations are tilted too much to equity. So here's a position where you might trim equity and move it into fixed income, or you might take highly valued stocks that have appreciated, donate it to a donor-advised funds. There are things you could do now to reduce your exposure.
Well, I mean, I think it was Jeffrey Gundlach said, hey, 25% in gold. Gold's going up. Now, I know that may be a large number to somebody like you, but the point being that you should be loading up in areas other than equities, perhaps because the reasons that you said. Valuations are rich by historical standards. How do you assess that?
We're loading up on high-grade, long-term municipal bonds. We've been doing that. Yeah. But within the stock market, there are great theses you can have and still have an excellent stock portfolio. So it isn't as if you've got to exit stocks across the board. First, look at the asset allocation and then find the sectors you want to be in.
But you say you should rotate out of small and mid-cap stocks when some people are just saying to themselves, hey, now's the time to finally lean in.
Disagree.
You say get out.
Right.
Why?
Because there's been a sea change in the market cap structure. First of all, companies are waiting a lot longer as private companies before they go public. And when they go public, they're jumping right over SMID and right into large cap. Secondly, most SMIDs are funded through floating rate debt. And so the argument now is, well, if the Fed cuts, rates are going to go down, their cost of capital will go down. I don't want to buy companies based on cost of capital. And finally, with the advent of ETFs, most investor money might go into SPY, and 40% of that is large cap tech. So that's where I want to be.
So you still see the large cap tech trade as outperforming the rest of the market over the remainder of this year?
For decades. And here's why.
You mean for decades to come?
Yeah, we've gone from the PC to the internet, cellular, mobility, cloud, and now we're in AI. These are evolutionary changes. And most investors are underweight these sectors and are not taking advantage of this type of growth. Sure, the stocks are very expensive and they'll pull back, but it's a great time to add for the long term.
And so you don't, when people talk about a bubble in this area, you don't pay any attention to that?
Well, naturally, what was going on with NVIDIA and the circular nature of the Oracle AI deal at first glance could look like the start of a bubble. But if you're running NVIDIA and you got $400 billion of operating cash flow in the next 4 years, and you're going to reinvest in the sector you know best, which is feed your little seedlings around the country and further your business.
Outside of tech, in the equity market, what's your favorite area?
Independent power producers, Vistra and NRG still, yeah.
But I mean, that's the AI story.
It is. A lot of our investments are circular around the core AI story. We also own banks, so we think the banks in a recovering economy are going to do very well. And look at what's, JP Morgan, Bank of America, Wells Fargo.
You don't think there's a bubble in any of the utility plays? Like, these are the new growth stocks. You know what I'm saying?
But
like, people are treating them like the hyperscalers or big tech growth names that they would invest in before.
Right.
Boring old utilities, which used to be a safety play, a proxy on yields. Now we're literally treating them like they are the new growth stocks.
Let's separate between the regulated and the independent power producers. The two IPPs that I own, Vistra and NRG, have operating cash flows of 9 and 10%. Now, they're reinvesting back in their business and they're expanding their capacity. So also, they're managing their balance sheet. Vistra has retired 30% of their float since I bought it originally in 2021. It's up 10 times since I bought it, still adding to it.
But don't you think at some point the whole process, power generation is going to become more efficient, and you're not going to need the amount that you think you do today, and then that's going to be the comeuppance for these stocks?
Definitely, that's the tail risk event. More efficient usage of electricity, but then we have the electrification of the world, whether it's cars, homes, appliances. So power demand is only increasing. So again, I've owned stocks for 5, 10, 15, 20 years. These are some names that I think there's a secular opportunity based on increasing demand for power over time.
All right, we got to run. It's good to talk to you as always. Richard Saperstein, thanks.
My pleasure.
All right.